Trump says the U.S. trade deal with China is done after tariff talks in London yield framework deal. Trump also said that President Xi and I are going to work closely together to open up China to American trade. This would be a great win for both countries. The timeline here is that in Geneva, Beijing and Washington agreed in May to put their unprecedented tariffs of over 100% on each other's imports on hold for 90 days. At one point, U.S. tariffs on Chinese goods were up to 145%. But now Trump said the deal would see China maintain its current 10% tariffs on goods imported from the U.S., while the U.S. would keep 55% tariffs on Chinese imports. And in other news, we had a CPI report that was better than expected. We were expecting inflation to tick up to 2.5% year over year, but instead we got just 2.4%. Continuing our trend of lower than analyst expectations in the inflation department is a very welcomed figure in tandem with this trade deal that Trump announced. And with this double whammy of good news here this morning, the NASDAQ is just about to hit its all-time high once again, a true V-shaped recovery to this freak out moment that spooked a lot of investors and a lot of traders out of their shares just in time for the market to rip back to fresh all-time highs. Like I said, we are at this point just a stone's throw away. That's what I used yesterday as my terminology, of less than 2% away from fresh all-time highs in the NASDAQ. What a crazy round trip to have seen such a sharp reversal in this market. But despite this bounce back, this is a hated market. And what I mean by that is that most market participants responding to the AAII Investor Sentiment Survey are still bearish in terms of which one of these are people feeling more bullish or more bearish. People, and in terms of people, I mean survey respondents to this, are still feeling bearish as of the latest investor sentiment survey here. People have been bearish through all of this sell-off, and the poor souls who got spooked out of selling all of their portfolio, I saw many people commenting that they were selling stocks or shorting stocks, thinking that the market was going to go much lower. You can see that while bullish sentiment has slowly started to rise a little bit, we still are coming off of very high levels of bearish sentiment in this market, and that is why partially, as cutthroat as it may sound, I think that the market may still have room to continue to push higher and to squeeze the bears who are on the wrong side of this trade. This morning's inflation data did cause the US dollar to move a little bit lower. However, the US and China trade deals are kind of offsetting that here this morning, and we see the dollar sort of flat, right? CPI was definitely a bearish catalyst for the dollar, but the China and U.S. trade deals kind of progressing in a way that looks like, okay, they're on the same page, is a positive catalyst for the U.S. dollar. However, the large slew of U.S. economic data that I think has been not super supportive of a strong dollar is continuing to suppress the price, and we're now just sitting here tight at support. Had we seen, trade negotiations materially worsen in any way, I think the dollar would have been much lower at this time. But again, one good, one bad for the U.S. dollar, two goods for the U.S. stock market at this time. And gold initially moved higher here, but has seen a little bit of a reversal here. Here's a 15-minute chart. You can see it popped higher on the inflation data points that came out this morning, suggesting that the Fed may be more willing and more able to cut interest rates for the remainder of this year. Take a look at the Fed Watch tool, and you can see that going out to our July 30th meeting here, there's still an 80% chance, according to the bond market, that the Fed will keep interest rates unchanged in the July meeting. However, there is about a 18 or 19% chance that we will see rates cut for the first time in July. Personally, I think there's actually a chance that we could get an increased probability of this number rising from here, based on a couple of factors. The first and very relevant one is inflation continuing to cool off more than people are expecting. This is a 1, 2, 3, 4 times in a row where inflation expectations were under-delivered, meaning inflation came in lower than analysts in the community thought it would. And so this is showing a pattern of inflation continuing to cool off more so than the market thought it was. And with trade deals happening and looking more promising going forward, that removes one of the big inflation question marks that I think the Fed had, which was the big sweeping tariffs. Obviously were very scary to the Fed, who was like, how can we justify cutting interest rates if the US and China are going into a terrible trade war that could send us into an inflation spiral? Well, Now we do still have tariffs to think about, and they still could cause some inflation, don't get me wrong, but we at least know that the probabilities of a worst case scenario where there's a massive, bid war in terms of how much tariffs are going to go on, that is out of the picture now. The market is back to the highs because we're no longer worried about worst case scenario tariffs are going to crush everything. Now we're talking about, again, 55% tariffs on Chinese goods, which could cause price hikes, don't get me wrong, but it's so much better than the feared 145% massive tariffs. So yes, there's still uncertainty around tariffs, and I think the Fed will still look at that and say, hey, we still want to wait, but I do think that the scenario now is much more promising. The landscape looks much better as more trade deals roll in for rate cuts to be appropriate because we are seeing some other economic data start to materially worsen. Take a look, for example, at services PMI, and we can see that the economy here is expected to actually contract according to key players in the economy who responded to the surveys. You can see the services PMI came in at 49.9 compared to the forecast at 52. Remember that a number below 50, like we see here, is a contraction expectation in this survey. Manufacturing PMIs have consistently been below 50, and now here actually got a even worse than expected number. We expected in the last manufacturing PMI number, we were forecasting for 49.3 to be our index number. Instead, we got 48.5. ADP numbers missed expectations, not just big this time, but big last time as well. And while we did technically get a beat on the NFP number, let's scroll down and take a look at our actual minus forecast chart. And you can see that the beat that we got on NFP was very narrow. It wasn't like a very strong, massive, better than expected jobs report. It was very much just kind of a so-so. We pretty much hit expectations. So with some of our economic data suggesting some weakness for the US dollar, I definitely remain more in the bearish camp of the US dollar. And that does take me to gold here, which I do think has potential to continue to push higher. I'd be very interested if we get either a break and retest of these previous highs or a pullback into this area of support around 3240 to 3200. Oil prices are also breaking out on today's announcement. Of course, cool inflation allows for Fed rate cuts, which could stimulate the economy, and the trade deal going well is also another bullish catalyst for oil. I have been bullish on oil. I am now looking for an opportunity to get into long positions on a pullback. If I get something like 64, this may be a trade opportunity for me, and I'll keep an eye on this one. Probably looking for some kind of move like this, at least a push up to the 72 level where I could start to trail stops on this trade. Like I said, waiting to see if we can get a pullback, and then I'd probably look for an entry. And if I do take a trade on this one, then I will share it inside of our VIP Discord. If you're not already inside of our VIP Discord, then consider joining because we're currently doing our biggest sale discount of the year. You can currently get 40% off using the promo code and link in the description down below of this video. And if you want an extra 5% off and you stuck through my little advertisement here, then you can get 45% off by sending us a direct message using the first link in the description down below in this video. Just send us a direct message letting my support team know that you'd like to join, and they'll give you some information about the membership and answer any questions that you might have about what the membership entails. With the group, you get access to every trade that I'm taking, my journal behind what I'm looking at in the markets with full explanations and breakdowns on everything. I trade Forex, commodities, indices, ETFs, stocks and options, and more. Not only my trades, you also get access to Alan's trades, who's another trader within our community. Chris Pulver is another service that you can sign up for if you're interested, and then Ivan also. Some of these people you may recognize from our live streams. So some people might be wondering, why aren't the indices up more than this already? Well, remember that the market is very forward-looking, and for days now we've been hearing, hey, things are going well in London. Hey, US and China are talking. The market has been fed a positive story about the Chinese-US trade relations for some time now. So this was already kind of expected, and we were just waiting to get the announcement. So we did get the announcement, and the market said, okay, pretty cool. And didn't really move too much. Remember, the market is always looking ahead. So people sometimes wonder why after a rate cut, the dollar doesn't move lower right away massively. Well, it's because the market already saw that rate cut coming and already sold the dollar beforehand, right? So we have to think about this as how smart the market really is. It's always looking ahead. And so this is why when the market sold off and people were so terrified, there was such great risk reward because everybody's expectations were so terrible on stocks and on risk assets in general. And then sure enough, when things weren't as bad as they actually were expected to be, the market reversed sharply. And today's video is sponsored by Vantage Markets. If you're looking for a better brokerage and you're outside of the United States, looking to trade CFDs on things like XAU, USD, S&P, NAS 100, and so much more, consider checking them out and taking advantage of their welcome bonus that they're currently doing for my subscribers. There's a link in the description down below, and if you use that link, you'll get access to the generous bonus that they're offering new signups. They also offer some great trading platforms and some very low trading costs. Check out Vantage down below in the description. Now back to the video. Taking a look at the put to call ratio here recently, you can see things have gone kind of back into neutral territory. We had gone from a very panicked market to a neutral market to a euphoric market back to a panicked market. Right now, though, we're kind of sitting in no man's land as we near the all-time highs. The Bitcoin to gold ratio did also go positive here above our moving average, showing potential demand for risk assets outweighing risk off assets. Remember that the Bitcoin to gold ratio just simply analyzes the price performance of Bitcoin versus gold. And so when this is trending above this red line or the 20-period moving average, we just consider that as more of a risk-on signal. And when it's below, we call that more of a risk-off signal. I also think it's worth mentioning looking at the seasonality for things like the Dow Jones, the Russell, the S&P. And by taking a look at this, we can see that we're going into a period of time where expected returns for the indices are pretty positive on a last 10-year historical basis. Once we get into September and October, things are a little bit not as exciting. But for the summer months here, many people sometimes know the old expression, sell in May and go away in the stock market. But in the last 10 years, that's actually been a really bad strategy. So we'll see if this year we get something similar. In today's Market Insights Market Pulse podcast, I discussed with Johnny Hart the announcement that Trump made here today, as well as the CPI report. Check it out. And by the way, if you'd like to check out the full link to the podcast, I'll leave it in the description below.
We've had some important news today regarding inflation where you are in the United States. The latest CPI numbers are out and they make encouraging reading for markets, do they not?
They do, Johnny. I mean, we had the last three before this in terms of a year-over-year CPI print were all better than expected. So this one, once more, came in lower than expected. So we call that a better than expected or a miss in CPI. But long story short, it's good for risk assets. It's good for this inflation struggle that we've seen in the United States, as other places as well. We do see a general trend lower in inflation, although I know before we talked about in the UK, we saw a little bit of a spike higher in inflation there. But let's hope that while this inflation thing is in the US improving, I imagine that they generally are going to continue to move together. So let's hope for that. In terms of the inflation print that we got today, 2.4% year-over-year inflation compared to a forecasted 2.5%. Previously, it was at 2.3. We did expect this thing to uptick to 2.5, but like I said, we only came in at 2.4. So that was a welcomed number here this morning. And initially, the markets celebrated this, specifically the stock market. The dollar index is lower here today, not by a huge amount, but back towards those lows that we've been watching here recently, around that 98.70 level, let's call it, on the DXY. We have seen the US dollar lose ground to most other major currencies for much of 2025 with all of the trade uncertainty, but also with some of the lackluster economic data that we've had in recent times. And so what this sets up for us as, traders watching the currency market is I think that this is likely to lead to rate cuts coming down the pipeline.
President Trump has said a deal is quote unquote done after those talks here in London. But he said that subject to final approval for President Xi and himself, the US will get the rare earth metal it needs, while Chinese students can take up their places at American colleges. So maybe those are the two sticking points where we're at. But it's very good news considering where we were just a few weeks ago. Obviously, last month, Washington and Beijing agreed a temporary truce over the tariffs, but each country has since accused the other of breaching the deal. But I think, bearing in mind it could have been so much worse, markets will see this as a bit of a result.
Yeah, and well, not only that, if we think about where we were, but the month prior to the pause on to negotiate, we were talking about tariffs on China of 145%. These crazy numbers that most market participants did not expect to stick. But they were scary, right? They just showed where the White House was at with it. clearly administration very unhappy with certain things with the trade dynamic with China. And so with things coming to a negotiation, and then now finally seems like we're reaching some deals here. There was a bit of vagueness on every little detail about the deals, but a deal nonetheless is far better than we were a couple months ago. So I think it's all relative. Like the markets are always going to look and say, you know, when we were covering on the podcast, Johnny, what was happening on those crazy, down days in the stock market following all these escalating trade tariff deals or tariffs imposed, we were sitting there looking at each other like, you know, where's this thing going to go? Clearly, there's no resolution. There's no negotiation that seems to be happening. And now the market's saying they're actively talking. They're making progress towards deals. And now they seem to have actually come to some sort of deal. And so the market is cheering that because that's a much more steady landscape. If you just say, hey, this is what we're doing now, that's a lot better than telling everyone we have no idea what we're going to be doing in the next few months. So that, I think, is a serious progress point. And why, by the way, we talked about this on the podcast at the time. Now that things look to be improving, the stock market's pretty much back at its all-time high.